Ever heard of two departments in the same company basically at war with each other over pricing? It sounds wild, right? But it happens all the time in huge organizations, and it can absolutely kill efficiency. So how do you fix it? Well, that's where divisional transfer pricing comes in. It's a really critical topic for your SCMPE exam, and today we're going to break down exactly how it works to create some internal harmony and, drive success. Let's get started.
So here's the game plan. First, we're going to dive into a classic corporate conflict just to see the problem in action. Then, we'll explore two really powerful solutions, the dual rate system and the two-part system. After that, we'll zoom out a bit to see how this all plays out on a global scale. And of course, we'll wrap up with a formula flash recap to make sure you've got everything you need locked in for your exam.
To make this all feel a bit more real, let's look at a case study. We'll see how this theory actually applies in practice at a company we'll call Global Multinational Ltd, or GML for short.
And yeah, like a lot of large companies with different divisions, GML is dealing with some pretty serious internal friction. And it's getting in the way of making the best possible decisions for the company as a whole. Okay, this table gets right to the heart of the problem. You've got three players, and they all have completely different goals. The CEO is looking at the big picture, right? Company-wide efficiency. For them, transferring goods at the lowest possible cost, the marginal cost, just makes sense. But the manager of the supplying division, DX, he's got his own performance review to worry about. Selling at cost means his division shows zero profit. No way. He wants a cost plus a markup. And then you have the buying division, DZ, who just wants the best price, period. They don't care if it's internal or from an outside company. This is a classic case of, and this is a key exam term for you, sub-optimization. Each manager is doing what's in their own best interest, which ultimately hurts the entire company.
So how on earth do you solve a problem like this? Well, here's one pretty clever way. Our first potential solution is the dual rate transfer pricing system. The name kind of gives it away. It's one transaction, but it's recorded at two different prices.
The core logic here is brilliantly simple. You let the selling division record the sale as if they made a profit. This keeps their manager happy and their performance metrics looking good. At the very same time, the buying division records the purchase at the lowest possible cost, which encourages them to buy internally. It's kind of like letting everyone have their cake and eat it too.
So let's get into the mechanics, because this is exactly what you'll need to explain in your exam. First, the supplier, division DX, gets to record the sale at its full cost plus a profit margin. That keeps them motivated. Second, the buyer, DZ, records the purchase at only the marginal cost. This encourages them to make economically sound decisions for the whole company. The result? We achieve two absolutely critical objectives. The first is goal congruence, another keyword for you, which is all about aligning everyone's incentives. The second is sub-optimization reduction, because we stop divisions from making choices that only benefit themselves. Now, it's super important to remember that this interdivisional profit is essentially just an accounting tool. It gets eliminated at the corporate level when everything is consolidated.
Now, let's talk trade-offs. The massive benefit is that this system really does promote cooperation, and it allows for a much fairer performance review of each division. The downside, though, it adds complexity. The books get more complicated, and you have to remember that the profits being shown are, in a way, artificial. They're a tool for internal motivation, not a reflection of external sales. In an exam question, you'd be expected to weigh these pros and cons. Is the benefit of improved cooperation worth the administrative headache? That's the strategic evaluation they're looking for.
And here's the direct impact, plain and simple. By putting this system in place, Division DX will finally earn a profit on its internal sales. And that gives its manager the incentive they need to cooperate fully with the CEO's bigger plan. So, problem one, potentially solved.
All right, let's move on to our second solution, the two-part system. I think the best way to think about this one is like paying for a product, but then also paying a separate cover charge just for having access to the factory in the first place.
So the formal definition is that the transfer price is the marginal cost per unit, plus a separate lump sum fee. This fee is specifically designed to help the supplying division recover its fixed costs. Things like rent and machinery costs that don't change with each unit they produce.
Let's break down the calculation here. Step 1. The buyer pays the seller at the marginal or variable costs for every single unit they take. This is great because it encourages them to order the optimal quantity since the price per unit is so low. Step 2, on top of that, the buyer pays a pre-agreed fixed fee, maybe like a monthly charge. This ensures the seller covers their overhead and makes a profit, which solves their incentive problem.
The beauty of this system is really in the outcome. Because the per-unit cost is low, the buying division is motivated to make decisions that maximize profit for the company as a whole. And because of that fixed fee, the supplying division is compensated fairly and also gets to show a profit. It's just another elegant way to achieve that all-important goal congruence.
So we've solved the problem for GML's local divisions, but what happens when those divisions are in different countries? Let's zoom out for a second because this becomes a much bigger and more complex issue for multinational corporations.
When a company goes global, the stakes of transfer pricing get so much higher. They might be sourcing raw materials from one country, like De Beers does with diamonds, manufacturing in another country to access low-cost labor, and then selling in a third. Every single time a component crosses a border between divisions, a transfer price has to be set. And this isn't just about internal motivation anymore. Now you're dealing with different tax laws, tariffs, and all sorts of regulations in each country, making this an incredibly complex strategic field.
All right, we have covered a lot of ground. To make sure it all sticks for your exam, let's do a quick formula flash recap. Think of it as your SCMPE cheat sheet for this topic.
Okay, here it is, side by side. You've got the dual rate system. That's where the seller records cost plus profit, but the buyer only records marginal cost. Its key outcome? It encourages internal trade and allows for better divisional performance metrics. Then you've got the two-part system. That's marginal cost per unit plus a lump sum fixed fee. Its key outcome is ensuring the buyer chooses the best output level while the seller recovers their fixed costs and still makes a profit. So, two different paths to the exact same goal, a company that works together seamlessly.
And that brings us to our final thought. Let's go back to our case study, Global Multinational Ltd. For them, which of these two systems do you think would be better for fostering not just immediate compliance, but genuine long-term cooperation between its divisions? You know, there isn't one right answer here, but thinking about the why, well, that's what strategy is all about.